Hello, Culture Matters podcast. Boy, am I excited for this episode today. Before I introduce our guest, here is a quote just for this episode. Knowledge has to be improved, challenged, and increased constantly, or it vanishes. Peter Drucker, our guest today, a consummate learner, leader, challenger, improver, friend to customers, builder of clients, builder of professionals in his space, is a frequent guest on the Culture Matters podcast. If you listen to the show, you know Pete Fournier. If you're in and around insurance and the advisory, services realm, you should know Pete. You should follow him. If you're in the industry of insurance providing and being that advisor, you might want to think about looking into all things insurance group. Thanks for coming back on the show, brother. I'm excited to talk about the customer, the journey, the value, and so much more.
Thanks for having me again, bro. Appreciate it.
I'd like to, as it relates to your industry, right? What comes to mind when you hear this Druckerism? Knowledge has to be improved, challenged, and increased constantly, or it vanishes.
Well, relating to our industry specifically, if you're not learning on a daily basis, you're probably dying, whether it be a slow or fast death, I guess, is determined on how much knowledge you consume. But our industry is ever evolving. I've only been in it 13 and a half years. It feels like a blip on the radar compared to some of these other professionals out there. But seeing the evolution, the different products, the different compliance issues that we have to deal with on a daily basis. It's very interesting to see organizations that have been set in their ways for so long start to either crumble or fall to the wayside because they're not adapting or pivoting, or they think their way is the best way, which it might have been for 2 or 3 decades, and now it can't even coexist with their competitors. So really interesting quote.
Was that part of your inspiration to start your company specifically? And
Yeah. So I started all things in November of 2021. I think we did maybe episode 2 out of our 4 when I was like just bringing it to fruition, which is crazy that it's gone by that fast.
in the house broom closet, now it's this huge thing.
Yeah. In the one-man bedroom office with 3 or 4 employees, or rather 14 agents. Now we're at like 400 something,
Wow.
which is it's been a wild ride. But yeah, that was kind of my motivation for developing the company and what it became today. Is we wanted to break the mold, or at least I wanted to, and give both the customer and the agent a better experience in all ways, shapes, and forms of the insurance industry. When it comes to the selling, the acquisition of a client, the continuous customer care that you have to provide, and the general all over experience between client and employee. Because without both the agents or the clients, I don't have a business.
Yeah, that's a great point. What do clients, what are they looking for? You know,
You know,
even if they don't know, like if we could try to
I
understand that.
Yeah, I think some of them have no idea, first and foremost. A lot of them, and I think this is more of a development of the recent past, I would say like the last 3 to 5 years, maybe, or even as soon as COVID hitting, is they want simple. A lot of our business has migrated to virtual or to telesales because of COVID. We still have a field force. I like to go to people's homes still, especially if it's a more complicated case. But at the same token, most of the consumers want, hey, I just want this term policy. I just want this final expense. Give it to me straight, quick. It's almost like an Amazon shopping experience. And the balancing act that I'm facing right now is you want to deliver simplicity, but you also want to deliver the correct messaging to the consumer, because just slinging a product doesn't help anybody. So you got to toe the line, and it's hard from a training perspective, getting the agents to not just be order takers. Because at the end of the day, if the consumer really knew what they wanted or what they needed, we would all be out of business. They would go online to some super conglomerate and just purchase whatever policy they want, you know?
Hmm.
Yep.
What some of the base policy, like if we were to there's branches.
Mm-hmm.
What are some of the foundational, I guess, branches or maybe roots? Is
Yeah.
it roots? You know, if I'm looking at a tree.
You have your standard term policy for younger folks, maybe, and I say younger, probably 18 to maybe 60. Purchase a lot of term insurance. I own a term insurance policy. I know you own a term insurance policy. It's a lot of death benefit for a
Yeah,
little,
great guy that did
right?
it.
Great
Solid
guy.
advisor.
So your standard term is a good building block, and it's relatively inexpensive. It's a lot of bang for your buck. Everybody should need it as long as they have liabilities. And then for the older folks, our senior market, I would say between 60 and maybe 85 or 89. The basic building block is a final expense policy. They're looking for a whole life to cover them, whether they die at age 90 or 190, to either put them in the ground or cremate them. Funeral and final expenses, hospital bills, that kind of thing. And on the
Mm.
life insurance spectrum, that's kind of the basics. And then there's basics in the annuity space, the Medicare space, the health space, that all lead up to a point of this, we'll call it the advanced market sector. And as you go up the steps, it gets a little bit more complicated per case, like some of the clients that we've dealt with together, right? Some of those policies are
Sure.
pretty complex. But from a servicing perspective, I think about, I want to say 60 to 65% of our revenue is still coming from the initial foundation. Your
And like
term, your final expense, your basic health, that kind of thing.
basic health insurance.
Yeah, correct.
And essentially those are if I get understand this correctly, I'm the consumer. I'm thinking standard term, thinking, what if I'm no longer here at an unexpected time?
Mm-hmm.
That's like a hedge on my
Yep.
existence. Basic health is I could get sick, and then there's these bills that could come in that so I'm alive, but I
Mm-hmm.
want a hedge.
Right. Correct.
And then the final expense, I'm thinking, well, what about when I'm no longer here and like all these costs that happen that other people would potentially have to.
Yep.
So that's like a basic foundation of where conversations start.
Mm-hmm. Correct.
Are there certain age ranges that you see that are more likely to reach out to an agent?
Yeah, I'm gonna say probably post 40, looking at our client base. It's very rare, and it's happening a little bit more now, but it's very rare for sub 40-year-olds, even like friends of mine, to reach out and say, "Hey, I just had a baby. I'm thinking about this." Like, no one's really thinking about it until they start to get a little bit older. Maybe they have some health conditions, or they get solicited by someone like myself. But if no one's bringing it to their attention, they're usually not reaching out.
Would you say that is it better to start sooner?
Oh, 100%. Yeah. I locked in my first whole life policy when I was 21 years old, and I'll never get rid of it because it's pennies compared to even what it would be now at 35 years old. So if you have the capacity to do it now, I mean, maybe not in college. I only did it because I was in the industry, right? Senior year of school.
Wow.
But as soon as you graduate, get something for yourself, or get with a buddy, a colleague, someone that you saw on TV, an advertisement. Like, sit down with some sort of insurance advisor and get something in place, because it will never be cheaper. And your needs are always going to evolve as the client or the consumer. You might have 8 kids, you might have no kids, you might get married 3 times, you might never get married. So everything will evolve, but as long as you have that precedent in place initially, you developed a CYA for yourself for your entire life, because we don't know what's going to happen.
Well, I got a question here. So, or first, I want to make sure I follow. It sounds as if the majority, let's say, in there, if it's rare to reach out
Mm-hmm.
for the consumer to reach out, sub 40, I'm thinking, you get out of college, general people, or like you get, maybe you didn't go to college, but you get some momentum in your late 20s and then your early 30s, and those 30s, the 40s, you're really starting to build your life. But if the majority of people are not reaching out to the agents, they're losing that time. So
Hmm.
that's like an opportunity for agents to be proactive. Like it seems like that would be a lot of opportunity for professionals, because see, I'm
Yeah,
trying to
100%.
contextualize it. Like,
I'm also 100% convinced, based on that, what you just said, if we had every parent, let's say, purchase either a whole life policy, an index universal life, some sort of permanent policy, maybe at 50, 100, $150 a month for their child when they were born or within the first month of them being born, I bet in like two-ish generations, we would probably end poverty or get close to it, because that generational wealth transfer, it doesn't have to be a lot of money, but imagine like your parents going or your grandparents going and leaving behind four, five, six, $700,000, and then
mhm.
it's skipping one more generation of a half a million or 600,000 or $1 million. What that could do. Now, some people would blow it, but at the end of the day, we would solve a lot of financial issues if people would get educated early. But insurance is not something that's talked about in schools or in financial wellness. People poo-poo it and they think they're going to get it from their job or whatever the case may be. So I think that's an important thing to realize is if we all started earlier, just like everything else, investing, protecting our well-being, our health, right? We're not sucking down Mountain Dews at 18 years old, just like everything else. We would put ourselves and our family in a better situation later on. We just don't think about it.
where where uh, where where would you say that you start with someone in that education process? So they are starting their to think about these things, and maybe they started with that. If I recall what you just taught there, the base of the health insurance, the final expense, the term, let's say that one of those, or maybe two of the three, or even all of them, is a starting point potentially.
Yep.
How would one go to increase the complexity without overwhelming, I guess, the
Yeah,
customer?
I actually trademarked. It's more of a pitch than anything else, but it's an educational pitch, and there's hundreds, if not thousands, of different structures for, let's say, life insurance. But really, they boil down into three. You have term for what if I die prematurely, or what if I get prematurely sick? Because like the product that you own and that I own, it will pay out in the event of a diagnosis of a critical, chronic, or terminal illness. So it's what if I die prematurely or what if I get sick prematurely? 98% of the time, knock on wood, you're not going to utilize a term. It's big what if insurance, but arguably you need it because it's a lot of insurance for a little bit amount of money. Then we have index universal life or universal life for we hope. We hope we get to live a long ass time, Jay, and we get to use this money as a tax-free retirement savings vehicle later on. Still comes with a death benefit, but we hope we outlive it and we get to use that money later. And then finally, we have whole life, which is for when. Either when we die, whether it's at age 60 or 160, or when we want to purchase something, because people don't realize, and unless they heard some touch points on TikTok or YouTube or whatever, you can utilize a whole life policy to finance things in your life: cars, trains, boats, planes, businesses, etc. So that's a very simple example of what all the life insurance policies really boil down to. Now, I could spend all day with you going into grave detail, but which one interests you the most at this stage of your life? And start there.
Mm.
And some people will say, oh, I just need a term, or I like that whole life idea, or what's index universal life? Explain that more. But that's the easiest way I've found over like 13 and a half years of doing this to explain it to a cold, quote unquote, consumer. They didn't fill out a
Mm.
lead form or whatever. They just want some basic understanding.
And what is the index? What is an index?
So index universal life is basically, without getting into the weeds, a permanent, quote unquote, policy that your premium payments are tied to both the insurance as well as index options from the insurance carrier. Now, don't get it twisted. This is not an investment. Your performance in the index universal life is based on the performance of the indexes that the insurance company is tying it to. So if your index goes up 35%, the insurance company is not giving you friggin' 35% returns. They might give you 9 or whatever the case may be, right? But when you utilize this money later on in your life, you're using it as tax-free policy loans, just like you do loans against Bitcoin or equities or real estate or whatever the case may be. You can take lifetime income loans on your index universal life. Eventually it'll go away and there'll be no more death benefit, or there might be a little bit left for your beneficiaries, but you're using that more as a retirement vehicle than anything else. That's the goal of it. And if you die prematurely, the death benefit gets paid to the beneficiaries as if that policy came to fruition. And the other thing that I want to let the at least audience know too, there's so many bad apples out there being like, oh, don't do a 401k, don't do an IRA, do an index universal or do a whole life. This should only be like 8 to 12% of your total portfolio. Like, it's the money that you can pretty much set your watch to within reason to be there later on, and without the drastic upswing or downswing of the market. Because if someone retired during COVID, they probably got their 401k slashed in half, and that would be a shitty year to retire. This one, there's no real risk of loss on any of your funds, but it's not as sexy as investing in gold or Bitcoin or stocks or whatever the case may be. So I usually advise clients 8 to 12%, maybe slivers of your portfolio, unless you're very risk adverse, then beef it up a little bit more. But there are other things that you can do with your money for much better returns.
What do you think the motive, or what makes you against the idea of uh, recommending against? That kind of sounds like an absolutism in a sense.
Yeah, well, one, we're in this business to make money, right? So the bigger the index universal life, or the bigger the whole life I sell you, the more money I make. It's also got to be structured correctly for the client. And if it is, we don't make a lot of money on it. But a lot of agents are running around being like, oh, yeah, you don't want risk in the market or whatever the case may be. You want steady income. That could be true, but like, no one should be invested solely in bonds at 32 years old. It's almost the same concept. You know, we're
Interesting.
of the age that you can take some risk. Now, if you're in your late 40s, early 50s, maybe you're getting closer to retirement, sure, that makes sense. But if everybody started in their teens or their 20s, or their parents purchased one for them for a couple $100 a month, they would at least know, like, I have one for my daughter, right? I pay about $300 a month, and she'll have $1.1 million, hopefully, estimation, by the time she's 39 years old. What a cool friggin' gift. And hopefully dad's still alive at 74 or whatever I would be, to be able to bestow that onto her, right? Um, and that's just a small portion of what her overall portfolio should be, in my opinion. Some people can argue the latter, but I've done pretty good in stocks, bonds, mutual funds, crypto. I would argue you should be diversified, at least unless you're a bajillionaire and you want to go all in with something, you know?
What is diversification as you see it? You know, interacting with all these different uh, types of customers in different walks of life. What have you? What's your opinion of what
I think it's
diversification
different
is?
for each customer segment, and those segments for me, I put them into 3 categories. We have standard W-2 employee, we have entrepreneur, and we have retiree or about to be retiree. And the diversification between, and I'm not a registered investment advisor, so this is not financial advice, but for like the W-2 employee, you see a lot of 401ks. You might see an IRA. You might see a 529 plan, which I might shit all over those. But you might see those basic building blocks of investments. And then maybe they incorporate a term policy, an index universal life, or a whole life. For the entrepreneurs, they're all over the place. And mainly for our entrepreneur clients, including myself, yourself, etc., the best investment that they can make is in their business. So if I'm tying up two, three, four, five, six, $7,000 a month into an insurance product, for some people it may make sense, But again, I want to see them have steady, static growth in whatever product they select because they're going to get better returns reinvesting into their own corporation. I'm going to show them maybe 7% returns over 30 years. It's not bad, but most entrepreneurs' ROI on their dollar is 1x, 2x, 5x. So they should be reinvesting in that. The third
Mm,
market segment, the seniors or about to retire, we're going to say 55 and older, let's say. They're getting closer to Social Security, getting closer to Medicare, et cetera. Maybe they're looking at pulling out their 401k, their IRA, their investments, whatever the case may be, and get fixed rate growth. Now we're in protection mode. We're not in growth mode. So we sell a lot of annuities in that retrospect. You see a lot of people converting to treasury notes or bonds or whatever the case may be, but diversifying in terms of there's no risk now. I don't think like a 65-year-old should be leaving their money in a dormant 401k so it could get slashed based on who's our president now. Like that's insane. You know what I mean? So post, I would say 55 years old, unless you're in an entrepreneur mentality. If you were a W-2 employee or still are, I would look at pausing most of the investment strategies and getting closer and closer to a fixed rate portfolio, especially nowadays. Take advantage of it because we will never see fixed rates this high, I don't think, in the next 20 or 30 years. You're talking 7, 8, 8.25% guaranteed for 20 to 25 years. That's insanity. So
mm.
take advantage of that if you're in the third market segment of senior or close to retiree.
This entrepreneurial section here, even you said, the entrepreneur has the uh, potential to get a huge return from their business.
Mm-hmm.
This is a thought that arises. Do you think there could be a scenario where if someone doesn't take as much into account the possibility of their counterpart's business and its return on equity, like its growth potential, that potentially they could potentially turn them almost into the mind of a W-2.
Yeah.
Meaning, like, if I have a business, I can generate a lot of cash quickly, more than just a person could, in
Right.
theory, potentially. So maybe 6,000, 5,000, 7,000, 3,000, like bigger numbers than a person would seem like okay to do. But tied up for long term, that could create issues in their business.
Right. Yeah. You don't want if you're using let's say a life insurance policy as like a forced savings account. We won't say investment, but like a forced savings plan, right? It should not hurt. When you're looking at your P&L, maybe it's, 5% of your total revenue or 10% or whatever the case may be. Like the numbers are all different for all different people, but it shouldn't feel pain. Because again, you're going to utilize most of your cash flow to reinvest in the business and grow it. The one thing I will tell the entrepreneurial segment is if you don't have a big ass term policy, you're an idiot. Because at the end of the day, your employees, if you have them, your spouse, if you have them, your beneficiaries, if you have them. Like I talk to business owners all the time, especially locally here, because we do a lot of networking events and stuff like that. You'd be so surprised. These guys have like 10, 15, $20 million revenue generating businesses, and they're worth like $500,000 dead. Like they bought a $500,000 term. Like, what are we doing? What happens to your company if you no longer exist? And in those terms, some of them feel like it's like wasting money because it's like protection. And we're talking about $4, $5, $6 million term policy. That might be $1,000 a month or whatever the case may be. But for the safety net of your employees' livelihoods, the livelihood of maybe your business partners or your spouse, like we sell a lot of key person policies, if you don't have at least that building block of protection, like that should automatically be baked into everybody's P&L.
Mm. Um, what does happen to a business if they don't have some type of hedge in that? What could happen?
Well,
What are some of the things you've seen or even?
luckily, I've only seen it like 3 or 4 times with clients that either had policies or like they just said no and they were in my warm market or inner circle. So I saw what started to happen. But uh, you have to use cash, like real money now, to continue to fund the business. Or in some scenarios, like we had a retail spot client, wife passed away. the guy had a closed shop, the food service industry, you know what I mean? But like that elimination of a key partner, and so why we talk about key person insurance and stuff like that, that could ultimately bankrupt the business. So why, in God's name, would you utilize your actual working capital if God forbid something happened to yourself, a partner, or a key employee versus paying a couple $100 a month for an insurance policy? It makes no financial sense to me.
Hmm.
And hopefully, because only about 2% of term policies pay out, you won't ever need it. But like you don't get workers comp or general liability or E&O insurance because you think you're going to need it. You get it because you have to have it, right? Or you should have it. It's the same thing as a term. It should just be baked into your P&L. And you should have it necessarily on yourself if you're an owner, a founder, a CEO, whatever the case may be. And you should have it on anybody that would provide a financial impact on your business if you lost them. It could be a spouse or a partner. It could be VPs, marketing directors, whatever the case may be. That's where a key person insurance comes from, because what would be the financial impact of your company if you lost that employee? Not even the replacement cost, but what would happen if, oh, Johnny died and he's my number two. You know what I mean?
Yeah, absolutely. I have a thought. Hidden cost of not. I think. What if? I want your thoughts on this. Could there be a hidden cost in the sense of not even thinking about these things? Because there'll be think there's a connection with vision and
Mm-hmm.
strategy. Like I think there's a hidden value in thinking about these things because you're now thinking. You're not just reacting to the day to day of the business of one's life. I think there's a hidden cost in not thinking about these things because in the absence of thinking in the future and addressing to think of the future, we have to address the present, and then that forces us to think about the past.
Right.
So I'm curious what comes to mind. Like I think there's a connection with even thinking about these things, and there's a hidden value and there's a hidden cost of not doing it.
Yeah. I mean, the hidden value is what once it's in place, it's over. And what are we talking about here to most business owners, right? Two, three, 400. Some of our business owners have like giant ass term policies. I pitched Grant back in the day, a giant ass term policy. He turned me down, but whatever. He was like, Elena will sell the jet. But like having that key component in place is it's just there and it's so negligible in terms of an overall business expense. Like who cares at the end of the day? If you as an entrepreneur can't afford three, four, five, $600 a month to make sure your business is fully protected, your business sucks. You know what I mean? At the end of the day. And the hidden
Mm.
costs to not implementing, one, you'll get it eventually. It's only going to become more expensive. If God forbid you get sick or whatever the case may be before you implement your protection, it's going to be more expensive, or you may not qualify for it at all. But the overall expense of not having either yourself, like I think about it every day for like I feel like I'm underinsured. If I got hit by a bus tomorrow, what would happen to ATIG? And would it be financially solvent to be able to hire maybe five, six, seven people to replace me to figure out payroll and commissions and everything like that? So you're talking about potentially spending 5x, 10x replacement cost of that one key person, especially if it's a founder, an owner, or whatever the case may be. Because you're going to be running around like a chicken with your head cut off if you lose that employee or your employees lose you. And money's just going to get spent. It just is. They're going to come up with solutions to problems. You're going to hire the wrong people, whatever the case may be. And people don't think about the exponential costs in the future of if something happened to a key person in a business.
Mm. How often would you recommend one meeting with their advisor?
At least annually. I mean, insurance is not, it shouldn't be a set it and forget it. But for entrepreneurs, a lot of times it's 6 to 12 months we do a policy review. For a standard employee or retiree, usually we meet with them once a year. And those meetings could be 10 to 12 minutes, or they could be 2 or 3 hours. You know what I mean? Like some people are like, oh, I'm good. I know what I got. Pretty savvy consumer. If there's anything I think they're missing, maybe we'll mention it for 5 or 10 minutes, but they're super quick. And then other ones are long, drawn out strategy meetings, especially in the entrepreneurial space. But I would review it every year,
Hmm.
like going for your annual physical, you know?
What would you say the general consumer perception is of the industry?
It's still, I think, like used car salesy, I don't really need this or I don't trust you kind of thing. I don't really know where that stems from, except a bunch of idiots still running around out there slinging policies based on commission and not based on the benefit of the actual client. Um,
Hmm.
but we're trying to break the mold on that as consistently as humanly possible. We only have 400 agents in a country of like 300 million people, so we can only do so much. But yeah, I wish the consumer, and I'm only one person, would have a mindset shift on going back to the days of sitting at the kitchen table with like a Ben Feldman or some of these like all stars in the insurance space and having like a 2 to 3 hour meeting with them, as opposed to like these quick hits, instant gratification. Hey man, I just need a term policy. I don't really want to talk about it. I want to spend $100. And you're like, what the fuck? Like, what are your actual needs? Because it's bad when we get an actual claim, a death claim, a sickness claim, illness claim, a disability claim, and we wind up cutting the check. We don't personally, obviously, the insurance company does, but we help with the delivery of the check. And it was drastically underinsured. You're talking about a guy that makes $500,000 a year and he just wanted a $300,000 term policy. Like that doesn't even cover your household income for an entire 12 months. It's sad. So allow
Wow.
us more so from a consumer perspective to advise you as much as humanly possible. Because I promise, whether you spend $100 a month or $200 a month or $500 a month, it's not going to make or break me from a commissions payable perspective. Like it doesn't matter. We're talking about nickels and dimes here. So I'm never going to push a product onto the client, and sure as hell my agent should be pushing products on the clients based on a commissionable, or a commission schedule. But at the end of the day, if you would allow us to actually go through fact finders, do a complete assessment of your financial well-being, you'll be in the best spot, and then you'll never have to look at it ever again. We'll meet
What
once
are
a
the
year.
important things to look at?
5 to 7 times worth income is a good measuring stick to start with, because at the end of the day, especially if you have a spouse,
Is
little
that net
kids,
income or gross income?
it depends on how you want to do it. If you're an entrepreneur, probably gross. If you're a W-2, it all depends. Um, Most of the time we're doing gross just because what's the difference between 80,000 and 59,000 take home? You might as well do the gross. You know what I mean? You're talking about an extra $5 a month in terms of your insurance product, but 5 to 7 times worth of income. If you have a mortgage balance, you would usually rope that in there. And then it's other things. Do you want your kids to go to an Ivy League school? Do you want to leave behind a retiree account? Do
Yes,
you
Harvard
want
is going to be $1,400,000 in 2022. I already, based
literally?
on 7% per. No, I'm serious. 7% a year. There's a great calculator. Yeah, I already did all the research. 1.4 million for Harvard for 4 years
Oh
for
my.
one child
Yeah,
in
like why?
2032. Why? Clearly, who they're going to meet. The future president of Abu Dhabi. But like,
Yeah,
well, y'all, I'm not even making this up. I went and on this website, and obviously, I plan on pushing all my issues on my kid, and they're going to have to
sure.
compensate for my insecurities and where I feel as though I failed in life. So yeah, if they were to go to Harvard, it'd be $1.4 million
Holy hell.
for 4 years. So should I add that to the?
Yeah, we might as well. That'll bump my commission a little bit. Yeah, if we add that. And then
Should I add that to the? So wait, mortgage balance. Hey, I mean, someone listening to this might not have thought of this. Like, go look up a school, anywhere in the country, and they have these calculators that'll tell you every year how it'll adjust for the increase in tuition.
Mhm.
and then it'll give you like an example of what you need to invest every month with a certain return to try to compensate to pay for that. Like they have those calculators. So I looked it up, and yeah, it's like it's a if we put 400 in the market now, like today, 1,000, maybe we wouldn't have to think about it.
Yeah.
Like that's how intense of a it is to think about sending a kid to a top school, like all that kind of stuff.
So insane.
So, but you would recommend that would be one of the things that you'd want to think about when you're looking at insurance, because you
Yeah.
could have all these big visions and dreams, like our listeners do, like we do, and then you die right before the kid gets to go to school or something like that. Like
Yeah.
that's what happens every day. That's your point.
Yeah. 100%.
So
And
I got go ahead. Sorry.
don't look at it as too, because we deal with so many clients that like, well, I don't want my kids to have that much money. Dude, like, first of all, set up a trust, set up custodians for the money. Like, you're not going to hand them a $1.9 million check and have them blow it on bullshit. You know what I mean? Be smart about it. But at the end of the day, what would you rather? Either them have the cushion for pennies on the dollar, God forbid something happened to mom or dad or whatever the case may be, or looking back and being like, yeah, my dad was a great guy, but he passed away, and he left us 20 grand, and that was enough to put him in the ground, and now I got no dad. Like the money is not going to justify for the loss of the person, but like, what are we talking about here? A couple $1,000 over the course of your lifetime to ensure that your legacy is not, one, pissed off at you, and two, can at least be financially savvy enough to make their own decisions later on, because they do have that nest egg or that cushion or whatever the case may be. Or maybe you don't want your you know surviving spouse to have to marry like a sugar daddy because you left no fucking insurance behind.
Yeah, and quite frankly, that's a damn good argument
Yeah.
because that probably could happen. I mean,
Yeah.
I mean, yeah, I mean that's a great argument for somebody that's making really good income. They get their spouse really used to it, and then
Yeah.
boom, they're gone. It's like, well, they got to go for somebody so much more successful.
We use that justification approach all the time for companies. Like, all right, and it's easier to target the man on this sales pitch, but like realistically, if I think about my own self, like I built this company to what it is. Maybe I carry it 10, 15 more years. You want somebody else coming in to take over your bit? No, you're going to leave your spouse or your business partners or whatever a nice nest egg, and hopefully that company keeps running. You don't want to give your baby to somebody else that has to do some
Mm.
takeover or whatever the case may be. That would suck.
So just to get this clear for our listeners, mortgage balance, potential goals,
Mm-hmm.
and then of course income is where one's starting to think about some type of term based on wherever they're at. It's got
Mm-hmm.
to be proportionally valuable, or else you're not maximizing the hedge essentially.
Right. I mean, you got to think about it. So I had a fraternity brother in college. His dad passed away when we were in college. I think he left him like 250,000, 275,000, which good for him. Like, glad the dad had life insurance. At the end of the day, after college tuitions, bills, the kid bought a house. He was out, 24 years old, no money left. Like, and this dude was like pretty financially savvy. Like, we interned at the same companies together.
Huh.
Like, he didn't blow it on drugs and hookers or whatever. He was just using it to pay off like college loans and
Yeah.
standard bills, and maybe get like a fixer upper house, and then it was all gone after 2 years. So like, how much are you actually leaving behind, and what's the cost to do that? The difference between 275,000 and $1 million on like a 40-year-old is negligible. I'm talking about 50, $60 a month. Like, who cares at the end of
Wow.
the day? You know what I mean?
Hmm. And I guess as we wrap up, like, what's the takeaway for our listener? What should they do? What's something actionable they can do right now to move themselves into a closer position to have this all figured, to start this journey, you know, of figuring out these questions and getting these answers?
Yeah, luckily there's millions of insurance agents and also unluckily millions of insurance agents across the country. I'm sure you know one in your inner circle. If not, visit allthingsinsurancegroup.com and I'll take care of you. But I'm sure you have one that's close to you. Just meet with them. It's not a weird conversation. Everyone should have it. Everyone needs it. So bring it to someone's attention if you're not getting solicited. You know what I mean? And always go for more. That obviously this is like slightly, it's going to sound jaded coming from an insurance salesperson, but like if you think you need 500,000, you probably need a million. If you think you need a million, you probably need 3 million. Like be realistic with what your take home pay is, what your liabilities are. I've met with clients that have 7 cars. They might have a little baby house for their mortgage, but you got 7 cars. Who's going to pay off those loans? You know what I mean? So actually go through a real assessment, because once it's figured out and it's set, you're going to have an annual policy review, and then like that's you're good. You're protected. There's one thing that you can check off your list pretty much for the rest of your life, or until you retire, because then your needs will change, you know.
Pete, thanks. I appreciate this master class that we're doing. Ultimately, a series. Hopefully, we can get some more information to the people that desire it, or those that don't even know yet that they may or may not be able to send their kids to college one way or another in 20 to 30 years without this information. So if you're listening to this, follow Pete, listen to some of the other episodes we've got on the Culture Matters podcast, where he shares stories and education and experience with you guys. And share this with a friend and leave us a review on the Culture Matters podcast. And we will see you next time. Thanks, Pete.
Appreciate it, bro.